In the world of investing, it's easy to get caught up in the day-to-day fluctuations of the stock market. One day your portfolio is up and the next it's down. But if you truly want to build wealth, the secret isn't in chasing quick gains, it's in thinking long-term. Long-term investing means holding on to investments for years, sometimes even decades. The goal? To benefit from the power of compound growth. This is where your money starts to earn money, and over time, the effect can be exponential. Patience is key here. Successful long-term investors understand that the market goes through ups and downs, but they don't panic. Instead, they stay focused on their goals and give their investments the time they need to grow. You're not trying to win every battle. You're aiming to win the war. By committing to a long-term strategy, you free yourself from the stress of daily market movements. You stop worrying about the short term and start thinking about where you want to be in 10, 20, or even 30 years from now. In this series, we'll explore the importance of long-term investing, why patience is your greatest asset, and how you can develop a strategy that builds wealth over time. We'll dive deep into concepts like compound growth, market volatility, and the value of staying the course, even during tough times. Remember, the best time to start thinking long-term was yesterday. The second best time? Today. Let's get started. One of the most powerful forces in investing is compound growth. You've probably heard the term, but what exactly does it mean? Compound growth is when your investment earnings generate their own earnings. It's not just about the initial amount you invest. It's about the interest or returns that accumulate over time. Let's break it down. Imagine you invest $1,000 with a 5% annual return. In the first year, you'll earn $50. In the second year, instead of just earning on your original $1,000, you're also earning on that extra $50. Over time, this compounding effect accelerates your growth. The more time you give your investments to grow, the bigger the impact. The beauty of compound growth is that time is your greatest ally. The earlier you start, the more exponential your returns can be. Even small, consistent investments can grow into substantial sums if you're patient enough to let them compound. This is why long-term investing is so effective. Short-term gains can be exciting, but the real wealth is built over decades. It's about giving your money time to grow and multiply. In this part of the series, we'll explore how compound growth works in detail, with examples and scenarios to show you its true power. We'll also cover why patience is essential in harnessing compound growth effectively. Remember, it's not just about how much you invest. It's about how long you let your investments grow. The longer you wait, the more powerful compound growth becomes. Market volatility is something every investor has to face. It's the frequent ups and downs in stock prices that can cause excitement or anxiety. But here's the truth. Volatility is normal. The stock market doesn't move in a straight line. It fluctuates, sometimes sharply. As a long-term investor, the key is not to react emotionally to short-term market swings. Instead of focusing on daily price movements, think of volatility as part of the journey. The market has always had ups and downs, but over the long term, it trends upwards. A good way to manage your emotions during volatile times is to remind yourself of your long-term goals. Are you investing for retirement? A future home? These goals don't hinge on what the market does tomorrow or next week. They depend on your ability to stay invested and ride out the inevitable ups and downs. We'll also explore how different types of assets react to volatility. Stocks are generally more volatile than bonds, but they also tend to offer higher returns over time. A well-diversified portfolio can help reduce the impact of market swings and give you more peace of mind. In this part, we'll show you how to embrace market volatility instead of fearing it. By staying patient and not panicking during downturns, you'll be able to keep your focus on the long-term rewards that investing can bring. Setting long-term financial goals is one of the most important steps in your investing journey. Without a clear vision, it's easy to get distracted by short-term market movements. But with solid goals in place, you'll always have a reason to stay the course, even during tough times. The first step is to define what you're investing for. Are you saving for retirement, buying a home, or building a college fund? Each of these goals has a different timeline, and that timeline will help shape your investment strategy. The longer your time horizon, the more risk you might be able to take, while shorter-term goals might require a more conservative approach. Next, break your goals into specific targets. Instead of saying, I want to retire comfortably, try defining exactly how much you'll need. Whether it's $500,000 or $5 million, having a number in mind will guide your savings and investment strategy. A key part of setting long-term goals is patience. Financial growth doesn't happen overnight. It takes years, sometimes decades, to reach your goals. But by staying disciplined and consistently contributing to your investments, you can build wealth over time. In this section, we'll walk through the steps to identify your financial goals, align them with your investment strategy, and stay on track. Remember, every investment decision you make should bring you closer to your goals. Focus on the long game, and the results will follow. Diversification is one of the most essential principles of long-term investing. It's the strategy of spreading your investments across different assets to reduce risk. You've probably heard the saying, don't put all your eggs in one basket. And that's exactly what diversification helps you avoid. When you diversify your portfolio, you're investing in a mix of stocks, bonds, and other assets. This balance is important because different asset types react differently to market changes. For example, while stocks might be more volatile, bonds tend to be more stable. By owning a variety, you lower the risk of a single bad investment dragging down your entire portfolio. Diversification isn't just about choosing different assets. It's also about balancing risk and reward. High-risk investments like stocks can deliver higher returns over time, but they're also more prone to short-term fluctuations. On the other hand, lower-risk investments like bonds offer more stability but may not grow as quickly. In this section, we'll dive into the benefits of diversification, explore how to build a well-balanced portfolio, and discuss why it's essential for long-term success. Remember, the goal isn't to eliminate risk entirely, just to manage it smartly. The key takeaway: diversification is your safety net. By spreading your investments, you're not just protecting yourself from losses. You're also increasing your chances of capturing gains from different areas of the market. Dividends play a significant role in long-term investment growth. When you invest in dividend-paying stocks, you don't just earn returns from the stock price going up. You also earn regular payouts from the companies. And when you reinvest those dividends, something magical happens. Those dividends start earning returns of their own. This is how compounding really takes off. For example, if you own a stock that pays a 4% dividend, you could take that payout as cash. But by reinvesting it, you're buying more shares of that stock. Over time, those additional shares also start to earn dividends, creating a snowball effect. The more you reinvest, the more your money grows. Dividend-paying stocks tend to be more stable than non-dividend stocks. That's because companies that consistently pay dividends are usually financially strong and profitable. For long-term investors, dividend stocks offer a balance of steady income and potential growth. While you might not see the quick gains that more volatile stocks can offer, dividend stocks can be an anchor in your portfolio, providing regular returns even during uncertain market conditions. In this section, we'll explore how dividends contribute to long-term growth, how reinvesting dividends can accelerate your wealth building, and why dividend-paying stocks can provide stability in a diversified portfolio. Patience pays off when you let your dividends work for you. Market downturns are a fact of investing. There will always be periods where stock prices fall, and it can be tempting to sell in a panic. But history shows that markets have always recovered, and those who stay invested during downturns tend to come out stronger in the long run. The key to surviving a market downturn is not letting fear guide your decisions. Instead, remember your long-term goals. Are you investing for the next year or the next 20 years? If your horizon is long-term, short-term drops in the market don't need to cause panic. One strategy is to avoid checking your portfolio too often during a downturn. The constant up and down movements can cause unnecessary anxiety. Instead, trust in your strategy and focus on the bigger picture. It's It's important to recognize that downturns often present buying opportunities. Stocks can go on sale during a downturn, meaning you can buy more at lower prices, which can lead to greater gains when the market recovers. In this section, we'll talk about the importance of staying calm, maintaining a long-term perspective, and how to take advantage of opportunities during tough market conditions. Remember, patience and discipline are your best tools during a downturn. Dollar cost averaging is a simple but powerful strategy that can help you invest consistently, regardless of market conditions. It involves investing a fixed amount of money at regular intervals, whether the market is up or down. Over time, this strategy helps smooth out the highs and lows of the market, leading to more consistent long-term growth. Here's how it works. When prices are low, your fixed investment buys more shares. When prices are high, you buy fewer. Over time, this reduces the impact of market volatility and helps you avoid the temptation to time the market. For example, let's say you invest $500 every month. In months when the market drops, that $500 buys more shares at a lower price. In months when the market rises, it buys fewer shares but at higher prices. Over the long term, this strategy can average out to a lower overall cost per share. Dollar cost averaging is a great way to stay disciplined and committed to your long-term goals. You're investing regularly, building wealth gradually, and avoiding the stress of trying to predict market movements. It's a strategy that works especially well for long-term investors who are focused on steady, consistent gains. In this section, we'll dive into how dollar cost averaging works, its benefits for long-term growth, and why it's a strategy that can help you stay on track no matter what the market is doing.